I'm starting the session. Respected speaker for the evening, Sunil Gabhawalla, Vice President Meerbai Sheth, Convener of Indirect Tax Committee, Mandar Telan. Dear participants, a very good evening to all of you. Goods and services tax has been one of the most dynamic legislation of the country in the recent past. It has been 50 months now since the promulgation of GST. Yesterday, the figures of GST collection for the month of February 22 were released. It was really heartening that the fifth straight month, GST collection has crossed 1.30 lakh crores. Since GST implementation, for the first time, cess collection crossed 10,000 crore mark. The robust technology platform, ever-encompassing mode of covering almost all the major activities of supply of goods and services, supplemented by effective tracking of movement of goods, has ensured that the unorganized sector is also brought into the organized value chain. This has ensured plugging the leakage of revenue and filling the coffers of the government. However, GST law is still work in progress, and there are lots of contentious issues which have to be addressed. Such contentious issues which have been dealt by the lower authorities without much application of mind increases the litigation and hardships for the businesses. Further, the absence of a GST tribunal under the CGST Act has resulted in series of writ petitions being filed before various high courts. Accordingly, there are many judicial pronouncements which are of relevance for the knowledge and guidance of taxpayers as well as GST practitioners. For this, each year, BCS ensures to have a lecture meeting to make professionals and businesses aware of some of the landmark judgments. We have today with us one of the finest exponent of GST law, CA Sunil Gabhawalla, also the Past President of BCS. Before I request CA Meerbai Sheth to formally introduce the speaker, I would like to briefly provide a glimpse of the activities at the BCS and for the benefit of those who are attending today's session and who may not be part of BCS family. BCS is the oldest voluntary body of chartered accountants. It is in its 73rd year. Basic aim of BCS is to disseminate knowledge to members, build their skill sets, and providing networking platform to like-minded professionals. It also acts as a catalyst by representing to the government bodies for bringing out better and effective government policies. It has a very large social media following with more than 50,000 followers on all social media platforms together. There are more than 20,000 YouTube followers watching avidly the videos of events at BCS. I shall exhort non-member CA professionals to onboard BCS platform as members to derive benefits in excelling as professionals as well as to give back to the society through your sharing of knowledge. I now request CA Meerbai Sheth to introduce CA Sunil Gabhawalla. Thanks and have an enriching 98 minutes of the session.
Thank you, Abhay. To introduce Sunil Gabhawalla is definitely a tall task, and I can go on with his achievements, his contribution to the BCS and to the profession, but I would probably like to be brief. Sunil Gabhawalla is a chartered accountant in practice with third rank at the All India level. He's also a cost accountant. He has an excellent academic record with ranks throughout the career. Sunil practices in the entire field of taxation with a specialization in indirect taxes. He is one of the leading consultants for service tax, VAT, and GST related matters. His firm has been ranked as one of the top 10 GST consultants for 2018-19 by the Insight Success magazine. He has delivered lectures on the topic of professional interest at various industry and trade bodies. And he's also a national accredited trainer and regularly conducts training sessions for department officers. He has also written articles in various professional and business journals and is regularly quoted in newspapers on indirect tax related issues. His comprehensive treatise on service tax, published by the Bharat Law House, saw 23 editions. Sunil has been actively involved in the policy formulation process of GST and keenly follows the developments in regard to this emerging law. His YouTube channel contains various videos on the topic and has generated more than 50,000 views till date. He mentors a pan-India community of indirect tax professionals on the front of GST implementation. Sunil was the president of the Bombay Chartered Accountants Society for year 2018-19 and is currently the co-chairman of the Indirect Tax Committee of the same society. He is also a member of the study group constituted by the Maharashtra government and the ICAI for implementing GST. So with this brief introduction, I hand over the podium, the virtual podium, to you, Sunil. Thank you for being with us.
Thank you, Mihir Bhai, for a lovely introduction. For the participants on the virtual platform, I need to put a small caveat. I and Mihir are very close friends, and perhaps therefore his words of praise were influenced by our friendship as well. Respected President, Vice President, seniors in the profession, and my dear colleague Mandar in the Indirect Tax Committee. It's indeed a pleasure to be speaking at a lecture meeting at the BCS forum. And when the president invited me to speak on the recent judgments in the GST regime, I was actually in two minds, because as the president rightly highlighted, the GST appellate tribunal has not been set up till date. And therefore, there has been a lot of substantive issues which have still not reached the court level. And at a ground level, there will always be various challenges in terms of a bias towards the revenue. And therefore, I was a bit skeptical about what type of decisions will I be able to present to the August participation over here. But when I went through the decisions, and of course, we have been reading these decisions day in and day out, and many a times we might treat some decisions as procedural or giving some relief here and there. And we might feel that, okay, this is one-off aberration. But when I actually sat around to prepare the presentation for today, I was surprised because I tried to just summarize the presentations and filter them out for the last 2 years of data, which is basically 21 and the 3 months of 22. So only a 15-month reported decisions is what was the filter for today's presentation. The second filter was the GST cases, and that too from the High Court and the Supreme Court. And friends, believe me or not, I came around with around 2,000 cases, around a 15-month period. And when I glimpsed through those decisions, I found an answer to a perplexed question which I have been having over the last 8 months. And I'm sure many of you would be having that question. We all know how the economy is right now. Yes, India is resilient, but post the pandemic, we have been suffering, and we are aware that the GDP is stagnant, and at some stage it was in a negative growth. The GST tax rate is remaining constant. And therefore, we always keep on wondering that if the GST collection has to be a multiplier of the GDP and the tax rate, how come every month the GST collections keep on increasing? I mean, at a macro level, how does it increase? And when I looked at these decisions, perhaps I got an answer to that question, that why is it increasing? And as we glance through some of those selected decisions, maybe participants, you will realize that yes, there is a little bit of an excess and some sense of a sanity needs to come in. With that little bit of a background, let me straight away jump into the decisions which we are going to talk about today. And these are all arranged in a particular order. But before we go into the specific decisions, let us understand what is the genesis of all of these decisions or the litigation which reaches a High Court or lands into the Supreme Court. Normally, when you are looking at an assessment or a generic process, any tax law would have a process of an assessment or make validation of the returns which have been filed by the assessee. And GST is no different. We have a normal assessment process wherein through a scrutiny of returns, all of us are aware that there is an ASMT 10 notice which is issued to find out prima facie mismatches in the returns. It might result in a pre-show cause notice, what is known as a pre-show cause notice, DRC 01A, which based on the response of the SAC might result in a show cause notice, which is a DRC1. Thereafter, there will be an order which will be passed by the adjudicating authority. Thereafter, you will file a first appeal against a pre-deposit of 10%. And thereafter, the law provides for a second appeal to the GST Appellate Tribunal. And there you will see the first stumbling block in this entire process. Due to the constitution of the GST Appellate Tribunal, consisting of more technical members as compared to judicial members, the entire constitution of the tribunal was challenged before a Madras High Court, and the Madras High Court stayed the constitution of the GST Appellate Tribunal. And therefore, today, we are at a deadlock. We have a situation where unless the constitution provisions of the GST Appellate Tribunal in the law are amended and a proper solution is found to it, we are unable to set up a GST Appellate Tribunal. Of course, the government on its side has issued a notification extending the due date of filing appeals to the GST Appellate Tribunal up to the stage when the GST Appellate Tribunal is set up. Therefore, essentially, you reach an end of the road after a first appeal. And that's one of the ways where, unless you want to really wait for a long period of time, you will have to knock the High Court saying that there is no effective remedy available against an adverse first appellate order. So that is one normal process flow. And here, of course, because you have already paid 20% and 10% and 20% as pre-deposits, many a times you will take a conscious call to either wait for the GST Appellate Tribunal to be set up, or you might want to go in and knock the doors of the High Court. Similarly, at times audit process takes place and then you have an ADT 01 resulting in a similar process thereafter, a show cause notice, a first appeal, show cause notice followed by an adjudication, thereafter a first appeal, and then again the same stumbling block of the GST Appellate Tribunal not being there. Many a times the GST law permits advance rulings applications, and there are lots of advance ruling applications which are being filed, most of them having a revenue bias, the orders having a revenue bias. You'll go to a AAAR, Appellate Advance Ruling Authority, and then again you face a stumbling block because the law does not provide for a next recourse after a AAAR. Of course, we try to move into the High Court, but the High Court again is divided on this process, and there have been High Court rulings saying that once a AAAR is being issued, it is a finality on the merits of the case. Yes, if the process was incorrect, we can intervene. Otherwise, the High Courts are also a little bit reluctant in intervening on this phrase. While all of this is happening, you also have goods being intercepted in transit, especially for e-way bill discrepancies. And then an MOV 7 is issued, resulting in an order in MOV 9. Then going into a first appeal stage, and again the same stalemate that the GST Appellate Tribunal has not been set up. These are the normal process flows, and there are remedies at different stages. And all of this becomes important because even the revenue officers at times are aware that the GST Appellate Tribunal is not set up, and we clearly see in many situations a revenue bias in the entire process prior to the GST Appellate Tribunal. And when that revenue bias comes up and there are a lot of uncertainties and difficulties at a business level, at times and again, taxpayers in any of these steps has to consider whether they should become a bit more aggressive and try a writ jurisdiction and try to approach a High Court by circumventing the normal appellate process. And we'll talk about it a little bit in detail as we go ahead, because this is a very commonplace dilemma which is now coming up as we find matters being confirmed without even cognizance of the submissions or detailed submissions made by the SSC, and just a one-liner order saying that either the SSC has not replied, which may be factually incorrect. In many cases, even the reply which has been done by the SSC is not taken into account by the adjudicating authority. And at times, even if they take the reply into account, they would just say that the reply is not satisfactory in one line against maybe a 10-15 page detailed response given by the taxpayer in response to the show cause notice. So how does one deal with these types of situation where essentially no principles of natural justice are followed, and how the courts have looked at it is what we will try to look at as we move into the details zone. Now, as compared to these normal process flows, there could be some specific process flows also, which may at times require an intervention from the High Court. Even simplistic things like obtaining registration and cancellation of registration, or at times revocation of that cancellation, we found that there have been issues which have reached the judicial forums. And it's pathetic, but yes, we are seeing these types of situations also happening where there is a non-application of mind, and therefore the taxpayers are left high and dry, and they have to approach the courts to resolve their day-to-day issues, because unless you have a registration, necessarily you are not able to conduct business at all. And that's where again we see some challenges on that front. The high number which we see in terms of the tax collections, to a large extent, the government pats its back and says that the data analytics have permitted a lot of investigation and search actions and specific actions which have permitted a lot of recovery. Now, again, when we are looking at this recovery, we find that at the time of investigation and search, there are lots of situations where provisional attachment is done, or there is a blocking of input tax credit under Rule 86B. And at times, there is a lot of coercion to at least deposit some amount either under protest. And what we generally know that when we reach February and March, there is a target-driven mechanism. And therefore, there's a lot of coercion to at least pay some amount in cash despite having substantial input tax credit. And if the SSC does not agree to pay that amount, then there are repetitive summons issued and called again and again. So all of these cases, there is a lot of a type of, you can say, an acrimony at some level. And again, in those cases also, there might be a need to approach the writ court. But having said that, there are so many situations where one might be immediately tempted to reach out to the writ court and try to resolve the matter once and for all. When we go through these decisions, we find that many of these decisions, the high courts are not very keen on preponing this entire situation and taking an onus. And generally, a basic legal principle that where an alternate remedy is available, the writ jurisdiction will not survive, is a major doubt which a SSC would always have. And that is the first stumbling block and a first objection from the revenue whenever the taxpayer approaches a writ court, because there would be some appellate remedy or some remedy available, or the matters may be premature. And therefore, in many cases, we find that the courts are not willing to really intervene in the situation of a writ court, or even if they intervene, at the most, they would say that they would issue instructions to the officers to follow the principles of natural justice or give some timelines for conclusion of certain processes. And therefore, in that sense, one has to be very careful while approaching a writ court. And I think I'll start my entire discussion of the decisions with regard to a live example. And we will talk about two specific cases where there was an e-way bill interception and the taxpayers approached the writ jurisdiction to a high court. And both of them, of course, went from the High Court all the way to Supreme Court. And recently, the Supreme Court has given interesting decisions in both those cases. So maybe it will be just an interesting starting point to take home how should we analyze whether one should choose a conventional appeal route or whether one should choose a writ petition route. And that's where I'll start with a very recent decision in the case of Satyam Shivam Papers Private Limited. This is a case where the matter went all the way to Supreme Court, and recently the Supreme Court came up with a detailed verdict on it. And it really reflects, when we go through that facts of the case and the proceedings which happened till the way it reached to the Supreme Court, it will clearly demonstrate what happens at a ground level. My fellow participants here, all of them are professionals, and all of us would understand and appreciate the fact that for one case which reaches a Supreme Court, there would be not less than 50,000 cases which either would be not agitated on account of non-materiality or agitated through the normal route, or being handled and the taxes being paid and forgotten as a business cost. And we all are aware of the risks of going all the way to the Supreme Court and the litigation costs involved in it. And therefore, when we go through these types of decisions, it suggests what is happening actually at a ground level. Let's look at the facts of this case. In this case, being transported against a valid tax invoice and a e-way bill, which was also a perfect e-way bill against the tax invoice. Now, when the goods were being transported, at that very moment, there were anti-CAA and NRC protests going on. and therefore there was a road agitation, Rasta Roko type of a thing, which resulted in the delay in transportation. This delay in transportation resulted in 1 day delay in the transportation of the goods to the destination, and the e-way bill validity had expired in the interim. Yes, there are provisions for extension of e-way bill. Unluckily, the transporter could not do that, and there was a delay of 1 day, which was also on account of a holiday because it was a weekend. And SAC submit, and of course, these goods were intercepted on the last day after the expiry of the e-way bill, as they were being taken to be delivered to the customer. And the SAC explained the delay and submitted all this information. The officer did not agree with those explanations, and he detained the goods. The question was not only of detention of the goods, but the storage of the goods. After detaining the goods, the intercepting officer kept the goods at the storage at a place of his relative, at a private location. Now, this is an important fact change which one needs to bear in mind. Naturally, the SAC wanted the goods, and for commercial reasons, he had to supply it to the customer. So, under protest, he agreed to pay the tax, interest, and penalty. And after paying of tax, interest, and penalty, he sought the release of these goods. To his utter surprise, when he sought the release of the goods, he found that part of the goods were missing or damaged. Now, in this background of the facts, the SAC was really left with no major choice. Of course, after paying the taxes, there would be an adjudication and confirmation of the order, and one can go through the appellate proceedings. And when we look at e-way bill, all of us are aware of the fact that the interception might happen in a state where you are not registered, and the taxes are paid in that state under a temporary registration, and therefore the appeal process would take its own sweet time. Now, in that background, the SAC knocked the doors of the Telangana High Court, and the Telangana High Court really gave a very detailed order. Of course, it entertained the writ petition and then gave a very detailed order saying that mere lapsing of the validity of the e-way bill period does not amount to an intention to evade the payment of tax. Now, this is very important. The original tax invoice was available and there was a tax plotted on it, and therefore the tax was expected to be paid in the normal course of time. And therefore, just because the e-way bill was lapsed and there was a sufficient reason which was explained by the taxpayer, and therefore the High Court came to the rescue of this taxpayer and said that this does not amount to an intention to evade payment of tax. And while the reasons given by the SAC were rejected, no specific reasons were given for rejecting those explanations. And again, the High Court was surprised that why were the goods kept in a private premises of some relative of the intercepting officer. With all of these, the Telangana High Court came to the rescue of the taxpayer and ordered the government to refund the along with an additional interest of 6%. Not only that, the Telangana High Court imposed costs of rupees 10,000 for this needless litigation and the harassment cost to the taxpayer. Against this High Court order, the department went into an appeal in the Supreme Court, and this Supreme Court order is the subject matter of our discussion, which we are talking about. And the Supreme Court really concurred with the views of the Telangana High Court. And it said that on the merits of the case, I do not see any reason to interfere with the observations and the findings and the conclusions of the Telangana High Court. However, it said that the High Court committed an error by only imposing nominal costs of 10,000. In fact, the Supreme Court went ahead and increased the cost to 69,000. And it also gave a liberty to the state to recover the same from the persons responsible for this entire needless litigation. So, friends, when you look at this decision, it really gives a lot of comfort, a lot of hope to all the taxpayers that yes, this is the state of affairs where even the judiciary is really sensitized to the difficulties the taxpayers face, the needless harassments that the taxpayers face. And in fact, the Supreme Court went ahead to actually increase the costs. And this was something which I found very interesting and a very important decision to take home and really try to make sure that there are not too many abuses or excesses against a particular taxpayer. Having said this, while a person might get euphoric with this type of a Supreme Court decision, I also need to caution of another decision just a few days thereafter on similar facts. In this situation also was of an e-way bill interception resulting in a demand of tax, interest and penalty. Of course, here there were not too many extreme situations like the goods being taken in a private warehouse or the goods not being fully available back, and a very strong reason like a delay caused on account of road agitation, etc. And again, the situation was the same. There was a confirmation of demand of tax, interest and penalty, and the High Court ordered refund of tax, interest and penalty. Here there was no ordering of interest on the refund amount, and there was no ordering of costs. Again, the Telangana High Court, this was also through the Telangana High Court, and again the Telangana government took it to the Supreme Court. And when it went to the Supreme Court's observations here were diametrically opposite. The Supreme Court here came out with a conclusion to say that against the order confirming the demand of tax, interest and penalty, an alternative remedy, a statutory remedy by way of an appeal was available. And if a statutory remedy of appeal was available to the taxpayer, the Telangana High Court should not have entertained a writ petition. Now, friends, this is where I think we will have to really weigh the difference in the facts between these two cases. Both the cases, end result was there was an e-way bill interception, but the circumstantial evidences and the entire process of confirmation of demand was very different in these two cases. And therefore, the Supreme Court in both those cases came out with very diametrically opposite end conclusions. In the first case, the writ petition was admitted and it was said that yes, it is a correct approach. And in fact, there was a cost which was increased by the Supreme Court. Whereas in the second case, the Supreme Court frowned upon the High Court for entertaining the writ petition. So this is, I think, something which in each and every case, as we keep on interacting with our clients and the taxpayers on a day-to-day basis, before we really approach in a writ jurisdiction, we will have to really question ourselves that is there any extraneous circumstance, something which is fundamentally wrong, something which is not appealing to the normal conscience. And if there is something not appealing to the normal conscience, yes, we should rush for a writ petition. But yeah, if it is something which is there, yes, there might be an abnormal tax, interest and penalty. But if there is an appellate route, just because there is some pre-deposit, and there have been decisions like this also, which say that because there is a pre-deposit and one taxpayer does not want to get his pre-deposit stuck in the normal appellate process, therefore chooses a writ jurisdiction, courts would not be very willing to come to your rescue in those types of situations. So this is the first starting point where we talked about the dilemma between applying for a writ petition or going through the normal appellate jurisdiction. With that, we come to some interesting decisions, and I've tried to summarize those decisions into different baskets for ease of understanding. Of course, they are not in the chronological order, and I've just handpicked, as I told you in the beginning, I will be talking only about the GST cases. There have been some more service tax decisions also, but that can be at some another forum. For today's discussion, we will concentrate only on the GST decisions. And that's where we go to the first segment of decisions, wherein we'll talk about some situations where courts have examined the taxability of particular transactions or the eligibility towards exemptions. And I think there I'll take up a very recent decision which came up in the case of Tagar Vasudev Amrish. This decision came out from the Karnataka High Court. And this is again a very interesting decision, wherein the Karnataka High Court analyzes an interpretation of an exemption entry. And typically the department context in an exemption entry is to say that the exemption has to be very strictly viewed, and they always quote a Supreme Court decision in Dilip Kumar's case and try to somehow say that the facts of the case don't fit within the exemption entry and therefore the exemption is not available. Now, how do you actually manage Dilip Kumar's case and also look at the interpretation of the exemption entry and what is the correct way of interpretation of that entry? I think this is one decision which will come to our rescue. And this decision, primarily, the facts of the case were there was a residential property which was owned by a particular landlord. It was leased out to another entity, a lessee, and that lessee was going to use that residential property for running a hostel for students of educational institutions. Now, as we are aware, there is an exemption notification which grants an exemption for services by way of renting. And these are the specific words in the exemption notification. Services by way of renting of residential dwellings for use as a residence. And here the landlord approached the advance ruling authority seeking a clarification of whether the lease rental received by the landlord from the lessee who will use it for a hostel purposes of the students, whether that will be eligible for an exemption from GST under this entry. The advance ruling authority held that the exemption is not available since the lessee to whom the property is leased out is using it for commercial purposes and not for his own residence. So the advance ruling authority tried to interpose the word for use as residence by the recipient. Though those words by the recipient were not there, somewhere the advance ruling authority tried to interpose, said that since the lessee is not using it for his own residence, therefore the exemption will not be available. The landlord filed an appeal to the AAAR, and the AAAR brought in one more dimension to it. He said that the exemption is available for renting of residential dwelling. And a hostel is not a residential dwelling at all. It is more a sociable accommodation. And these are the words used in the AAAR. A sociable accommodation and not a residential accommodation. Now, agreed against this AAAR order, the landlord filed an appeal in the High Court. The appeal was admitted, and of course, we are always, as I stated at the start, there is a doubt whether a High Court can entertain a AAAR on appeal against a AAAR. But in this fact matrix, the High Court did accept and admit the appeal. And what the High Court analyzed was that when I am reading this exemption entry, yes, it has to be strictly read. And strictly read does not mean only strictly read in favor of the revenue. It just means that you have to literally read what is written. And when you literally read what is written in the entry, it says services by way of renting of residential dwelling for use as residence. And therefore, the High Court said that there are two questions which you have to ask. What is being rented? What is it? Is the property which is being rented, is it a residential dwelling or not? Is the first question which is to be asked. And the second question which has to be asked is the purpose for which the property is actually used, because it says for use as residence. So the purpose for which the property is used. Now it then went into analyzing both these questions. It said it went into various decisions and the dictionary meanings, and then came to a conclusion, and rightly so, that when you look at the word residential dwelling, it basically would take a color from the fact that it is meant to be used for the purposes of residence. And there were decisions which were quoted from the property laws perspective and other laws perspective, which went ahead to say that this property can be treated as a residential dwelling. Thereafter, it went ahead to say that the purpose for which the property is used, the students actually use it for residing there. And there it was analyzed that when you say that some property is used for residence, it means that they are staying there, they are consuming food at that location, and they are enjoying that period of stay. Now, that period of stay may be temporary, it may be a mid-term, it may be a long-term, that does not matter. And what the High Court also said was that the end purpose for which the property is used is relevant, not the intermediary lessee who one might say is applying the property for a commercial gain. But that is not relevant. The end objective and the end uses of the property is that there is a hostelite who is staying there, and that is for the purposes of residence. And therefore, the Karnataka High Court said that the transaction is eligible for an exemption under this entry, and therefore no GST is payable. I think this is a very interesting and a favorable decision which one will have to bear in mind. Only risk which we see is the Supreme Court perhaps overturning this that the Karnataka High Court should not have entertained an appeal against a AAA. So that is a small risk which one needs to bear in mind. Otherwise, on principle, a well-reasoned decision which has come out from the Karnataka High Court. That takes me to a not so recent decision, but yet in 2021, we had this decision from the Madras High Court in Greenwood Owners Association case. Again, this has been a situation of cooperative housing societies, resident welfare associations. And as we know, they have always been a subject matter of substantial litigation. Till the last year, we always felt that there is a principle of mutuality. The SSEs fought all the way to Supreme Court, and there we had Calcutta Club in the context of VAT and service tax, which held that mutuality principles applies to indirect taxes, and therefore no service tax or VAT could be collected. As far as GST is concerned, we saw an amendment in the GST Act, a retrospective amendment, trying to do away with that mutuality principle. And while all of this was going around, there was an exemption entry, even under the service tax law and then under the GST law, which said that a service is by a resident welfare association up to rupees 7,500 per month per member were exempted from payment of GST. Now, the interpretation of this exemption notification was a subject matter of dispute before this High Court. And as we are all aware, when the GST law was introduced in the initial days of the GST law introduction, the CBEC clarified that if there is a scenario where a resident welfare association collects 8,000 from a particular member, the question was whether that entire 8,000 becomes taxable or it's only the 500, which is 8,000 minus 7,500, which will become taxable. And the initial clarification from the CBC said that it's only the excess of 500 which will become taxable. And therefore, for each transaction vis-a-vis each member per month, one assumed that 7,500 was sort of a basic exemption and only excess amount would become taxable. However, later on, another circular was issued to clarify that this up to rupees 7,500 is meant to give relief only to small members. And if there are luxury apartments and rich members, in that case, this 7,500 would not apply. And therefore, a later circular clarified that if a society or a resident welfare association collects 8,000 per month, then the entire 8,000 would be taxable and the basic exemption of 7,500 would not be available. There was an advance ruling also holding a similar view, saying that the entire amount would be. In this context, the Madras High Court went into analyzing the exact impact of this word up to. And it went into the exemption notifications both under the excise law as well as under the GST law. And it found that there were various situations where monetary limits were prescribed. And there were different words used in different places where exemptions or concessional tax rates were given. In some cases, the words used were amounts not more than. In some cases, we were told amounts not exceeding. For example, when you are looking at a theatrical entertainment function, we were told an amount not exceeding or an amount not more than rupees this much per ticket. As compared to that, the word used for this exemption entry was up to. And when we compare up to versus not exceeding or not more than, what we are told is that this 7,500 acts like a slab. And therefore, irrespective of the amount collected, an amount up to 7,500 would always continue to remain exempted, and it's only the excess over 7,500 which would become liable. Again, a very balanced decision trying to analyze the various phrases and give a very detailed perspective to this entire aspect. And I think, again, a very good decision on that front. That takes me to another decision wherein it ultimately resulted in a difference of opinion, a very favorite topic. And before this decision came, in 2019, we had a decision from the Gujarat High Court in Material Recycling Association's case. And thereafter, this matter came up from the Bombay High Court, wherein the issue was taxability of intermediaries. And ever since the service tax law was amended to introduce a service tax on intermediary services, even if they are provided to foreign recipients, the entire sector has faced lots of difficulties. The fact that you are not able to collect it from the foreign recipient, the fact that this results in double taxation, and the fact that it conflicts with the fundamental principle of destination-based consumption tax have been the pain points. And therefore, various representations have happened from time and again to try to resolve this embargo or resolve this mess. Somehow the government has not been able to make a policy change or an amendment in the law. And that's where I think the taxpayers had to knock the courts to find out a solution to this issue. And typically in this entire matter, the debate or the prayer was that the provisions of section 13(8)(b) of the IGST Act, which define the location of the supplier as the place of supply for intermediary services, that provision should be treated unconstitutional. And that is where there was a difference of opinion of Justice Ujjwal Bayan in his decision goes into a very detailed analysis. Both the justices have given a very detailed analysis of their thought processes. Justice Ujjwal Bayan starts by saying, and there's a lot of discussion around this, that GST is a destination-based consumption tax, right from talking about the AIFTP's decision and going all the way to various international and domestic precedents. It is sort of canvassed that GST is a destination-based consumption tax. There's a lot of discussion around Article 286 of the Constitution. The first subclause of Article 286 restricts imposition of tax by states on supplies outside that state and supplies in the course of import or export of goods or services. And thereafter, Article 286(2) enables the Parliament to formulate principles. And what Justice says is that while Article 286(2) enables Parliament to formulate principles which permit them to prepare through the IGST Act to prepare the place of supply rules, but what the Justice observes is that Article 286(2) cannot be used to deviate from the scheme of Article 286(1). And what is that scheme of 286(1)? There is a restriction of taxation. And therefore, the Justice in Article 286 as a restrictive article, restricting taxation in certain cases. And with that objective in mind, Justice Ujjwal Bayan held that Section 13(8)(b) is ultra vires the Act and ultra vires the Constitution. And it proposed to strike down the entry or relating to intermediaries. Now, of course, as I was highlighting, there is a dissent to this, and the second Justice Abhay Ahuja, passed another order, dissenting order, again a very detailed order, and he made a few very interesting points. He started and went into a detailed analysis to say that there is always a presumption of upholding the constitutionality of any provision. He says that whenever matters of constitutional challenge come up before the courts should not start with an assumption of assuming that the provision is unconstitutional. There is an inbuilt presumption that the provisions of an act or a rules are constitutional. And again, a very detailed commentary on that front is available in the decision. And that was something which weighed very heavily in the minds of Justice Abhay Ahuja. The next important point which the justice made was that we need to bear in mind that GST is a tax on supply. We look at the provisions of the law. Yes, we somewhere say the economic concept of GST is that it is a destination-based consumption tax. But when we look at the Act, we look at the Constitution, the provisions are imposing a tax on supply. Being an indirect tax, you are able to collect it from the consumer. That's a secondary and the economic or the commercial side of it. That is not the legal side of it. The legal side of it is that the tax is on a supply and not on consumption. Therefore, undue emphasis on the principle of destination-based consumption tax does not take you anywhere. That was the sum and substance of the aspect over here, that the focus should be on the aspect of supply and not on the aspect of consumption. Again, Justice Abhay Ahuja goes ahead to say that many a times we say that IGST is VAT, but essentially IGST is not value-added tax, calculated as a value-added tax. Again, a very important observation, because many a times wherever input tax credits are denied, we always say input tax credit is a concession, then a right. And that's another debate which we can keep on having, whether ITC is a right or a concession. But this observation of Justice Ahuja clearly suggests that while we keep on saying IGST is on value added, it's actually not on value added, it is on the gross value. And thereafter, if you are eligible, you claim the input tax credit. Otherwise, yes, there can be a cascading impact of taxation, though it is against the fundamental principles of taxation. Well, be as it may, the statutory backing, the constitutional backing does not suggest that GST is only on value added, but it is on the supply itself. And based on these aspects, the justice then goes into the interplay of section 13.8 vis-a-vis the exports. And on this aspect, the justice brings about a very interesting dimension to this entire debate. The debate is that Article 286 does not permit taxation of exports, which as per the Justice Ahuja is incorrect because there is no concept of destination-based consumption tax. The tax is on the supply and the supplier is clearly in India. Having said so, he also says that whether a transaction is export or not, we are somewhere getting influenced by section 2, subsection 6 of the IGST Act, which defines export of service in 6 baskets, 6 conditions. And one of those conditions, of course, there are 2 conflicting conditions in this context. One of the conditions is that the recipient is located outside India. And another condition, of course, is that the place of supply should also be outside India. Now, what happens is when we try to analyze intermediary and we say that the definition of intermediary and defining the place of supply of intermediary as the location of the supplier results in an export being taxed, there is somewhere an inherent assumption that section 2.6 overrides section 13.8. And that is what the Justice Ahuja says is incorrect interpretation. He says that section 2.6 is a general section for all exports or all transactions, as compared to that section 13 lists down various specific scenarios. And therefore, a specific section 13.8b dealing with intermediaries will override the general section 2.6, one of the subclauses which talks about the location of the recipient being located outside India. And therefore, in his view, the transaction cannot conventionally be considered as an export at all, because the whole objective of defining an export in the context of services is that you will define a transaction as an export based on proxies. And those proxies are the place of supplies, which in this case, the legislature in its policy wisdom has decided that it is the location of the supplier. Takes us to the last point of debate, which was Article 286. And here, Justice Ahuja very clearly tries to bring out that the purpose of Article 286 is to empower the parliament. And it's not meant in any way to restrict taxation. Article 286(1) might restrict taxation, but that is only for the specific states. It does not mean that the parliament has also stripped itself away from the powers of taxation of interstate supplies or taxation of imports or exports. And therefore, Justice Ahuja does not see any challenge in Article 286 vis-a-vis section 13.8b. And accordingly, we find that in Dharmendra Jani's case, there is a difference of opinion, 2 diametrically opposite opinions presented by the 2 justices. The ball is open now, and therefore it will be for a third member to take a final decision on this front. Having said so, I would believe that this decision, while it does touch upon intermediary and the taxability of intermediary to some extent, it has no relevance in understanding whether a particular transaction constitutes intermediary or not. We are seeing lots of situations where at a ground level, many transactions which are undertaken on a principal to principal basis, like BPOs, who would be providing call center services or different types of services to their clients situated abroad. They would get notices saying that, look, we believe you are intermediaries and therefore we will demand a tax or reject a refund. Now, of course, we have a CBC circular trying to bring out the scope of the concept of intermediary. And I think those circular and the benevolent circular and those principles don't change at all based on this DOO opinion. This DOO opinion and the final outcome will only determine situations where we are admittedly agreeing that something is an intermediary, and whether such intermediary transactions should be taxed or not is something which will be a subject matter of the final outcome of this DOO. That takes me to the second basket, and this is the one basket where you will see there has been a lot of action happening around. And input tax credit. As we have looked in the earlier decision, we always, when the GST was introduced 50 months back, there was a unique selling proposition of GST. We were told that we will get seamless credits, and over the last 50 months, we have seen that we are seeing less and less and less of credits, and there has been a lot of challenge on this basic assumption of a free flow of input tax credit across the country. Various reasons for that, but well, we've seen lots and lots of decisions on this front. So we'll touch upon a few of the important decisions in this regard. And here I will just start with one interesting decision which started in ARS Steel's case and thereafter went into RK Ganpati Chetiar's case, both of them from the Madras High Court. The issue here was interpretation of Section 17(5)(h) of the GST Act. As we know, the said provision blocks input tax credit in respect of goods lost, stolen, destroyed, written off, or disposed of by way of gift or free samples. There have been a series of advance rulings trying to interpret the provisions. As I started my preamble, I said that I am not touching upon any of the advance rulings, but only restricting my discussions to High Court and Supreme Court decisions. And this High Court decision has had an occasion to examine this scenario in the context of inputs which get lost naturally in the manufacturing process. And as students of costing, all of us are aware that losses in a manufacturing process are many a times normal losses, and there will be some element of evaporation, damage to the inputs before those inputs get converted into final products. And there was a scenario where the input tax credit was sought to be denied on raw materials or inputs which are lost in the inherent process of manufacturing of the final product. And this was being challenged in the Madras High Court, and Madras High Court relied on the Rupa and Company's case of the VAT regime and then said the situation doesn't change in GST. And it goes ahead and identifies the test. It says, and these are the observations of the High Court itself, it says the situations as set out above in the 17(5)(h), of course, indicate loss of inputs that are quantifiable and involve, now this is an important phrase, external factors or compulsions. So yes, if I have bought inputs, they are in my warehouse and there is a fire, the inputs gets lost because of the fire. Yes, perhaps that will get covered within this entry. But if I am using those inputs in the manufacturing of the final product, and in the manufacturing of the final product, there's some spillage which is natural, or some evaporation which is bound to happen, or some excess, let's say if it's a steel sheet, there will be some corners which will have to be destroyed as scrap. Now those are inherent situations of losses. And that is where the High Court says a loss that is occasioned by consumption in the process of manufacture is one which is inherent to the process of the manufacture itself. And that is not something which is envisaged or which requires a reversal of input tax credit under Section 17(5)(h). Again, a very balanced and a correct decision relying on earlier decisions from the context of VAT. And I would believe this will go a long way in clearing the air as far as this entry of interpretation of the block credit is concerned. That takes me to a decision which we always keep on talking about. As we are aware, today we find situations where there are show-cause notices issued in random. And many of those show-cause notices try to demand a reversal of input tax credit on the ground that the supplier has not paid the tax. This is slightly different than a situation where the supplier has paid the tax but not appearing in your GST R2. But right now we are concentrating on a scenario where the supplier has not actually paid the tax at all. Now, we are aware that 16(2) has one condition which says that for claim of input tax credit, the tax has to be paid to the government treasury. We are also aware of a series of decisions in the VAT regime wherein the courts have consistently held, Orisa India and many others, where the courts have consistently held that a recipient cannot be penalized for the default of the supplier. And if the supplier has not paid the tax, the recipient cannot be called upon to reverse his input tax credit. But then when the matter went to the Madras High Court in D.Y. Bethel's case, the word of caution, and this is a two-edged decision. At the outset, the decision says, while it quotes the decision, earlier VAT regime decisions, it highlights that the VAT regime was a bit different than the GST regime. And therefore, somewhere, though it's not explicitly written in so many words, the High Court was colored by the fact that Section 16(2) has a very explicit condition requiring the payment of tax to the government treasury. And therefore, it says that yes, the old decisions may not apply in the current matrix. But at the same time, each and every case where the supplier did not pay the tax does not mean that the recipient should reverse his credit. What the High Court went ahead and said was, it tried to observe, it asks a few questions that look, the supplier is registered by the department, he has collected the tax from the recipient. What is the effort taken by the department in recovering the tax from the supplier? Many a times, the department finds that the recipient is a soft target, and therefore, it circumvents the method of approaching the supplier. Maybe the supplier is running scot-free after collecting the tax from the recipient, and the recipient is expected to reverse input tax credit. And this is the type of the position or the situation which the Madras High Court in this decision tries to frown upon. It says that while credit can be denied on account of non-payment of tax, it cannot be denied before exhausting the remedy from the errant supplier. So therefore, it is important for the department to establish that they ran after the supplier, they issued notices to the supplier, recovery notices, and despite undertaking those efforts, the tax could not be recovered from the supplier. Only when the tax could not be recovered from the supplier that the recipient can be expected to reverse an input tax credit. Therefore, this decision somewhere brings in a secondary liability on the recipient rather than a sort of a primary liability, which many a times in terms of the actual notices we find happening. So in that sense, it's a useful decision, but it's not, we should not go overboard on this decision and assume that all cases we will win on this decision, because it clearly says that if effectively the tax has not been paid, the credit will not be available. Only thing is there's a stumbling block in between that the department has to establish that the supplier has been chased after and efforts have been taken to recover the tax from the errant supplier. That takes us to another decision where essentially the tax has been collected, it has been paid, and it is also appearing in the GSTR2A. And as we are aware that nowadays there has been a lot of action primarily from the DGGI and at times from the anti-evasion wings, wherein there is an allegation that there has been a trading of invoices, or what we say fake invoicing, without actual supply of goods or services. Of course, there's another dimension to it, and one can always debate whether there is really a loss of revenue to the exchequer, because essentially the supplier might have collected and paid the tax. It reflects in the 2A of the recipient, but somewhere the department believes that you have not received the goods, you have only received an invoice only for the purposes of adjustment of, let's say, income tax profits, or for the purposes of banking system or various other reasons, you have undertaken this type of circular trading or fake invoicing. And in these cases, many a times we see that there are enforcement actions against the suppliers, and at times the officers cancel the registration of the suppliers with a retrospective date. Now, in this scenario, when there is a retrospective cancellation of registration of the supplier, whether it will impact the credit claim of the recipient, and necessarily we are seeing that there are lots of actions happening at a ground level where the DGGI or the anti-evasion or the jurisdictional officers trace the recipient and chase them to reverse the input tax credit on the grounds that one of the conditions of section 16(2), which is the receipt of goods or services, is not being satisfied in this scenario. In this case, the Calcutta High Court had similar facts before itself, and it made a few observations which were very useful. It said that on a prima facie looking at the documentary evidence, and it said that a tax invoice is a very strong documentary evidence to suggest that the transactions are genuine. There was an e-way bill, there was a tax invoice, there was a lorry receipt, and all of them, and the payments were made primarily from banking channels. And based on that, the Calcutta High Court says that there is a documentary evidence to suggest that the transactions are genuine. It also observed that the transactions were undertaken before cancellation of registration by the supplier, by the department. It also observed that the payments were made to the suppliers by normal banking channels. And despite all of this, the Calcutta High Court did not give an affirmative view, while it has lots of observations on each of these aspects to suggest a bias towards the taxpayer or towards the petitioner. The end result of this Calcutta High Court decision is that the matter was remanded back for verification on these specific points, and more importantly, to identify whether the petitioners had undertaken at the time of the transaction appropriate due diligence and whether they had at that point of time verified the identity of the supplier. So therefore, to verify the bona fide of the transactions, the matter was remanded back to the ground level authority. So again, a useful decision, but just falls a little bit short of the finish line as far as this decision is concerned. And that's where on similar facts, we have an Orisa High Court decision in Bright Star Plastic Industries, which is again on similar facts, is a more informative decision. And these are some of the observations, and I reproduced those observations for the participants here. It says, on the date the purchases took place, there was no means for the petitioner to know that the entity which had a valid GST number was in fact non-existent. Now, this is actually the case built up by the department that the supplier is not existing or the goods were never there. Now, if the supplier was not existing, the number was given by the department itself. And nowadays, as we know, there's a lot of physical verification which happens before a number is allotted. And therefore, the High Court says to attribute fraud in such circumstances, the department would have to satisfy a high threshold of showing indulged in the transactions with a full knowledge that the selling dealer was non-existent. The department would have to show that somehow the purchasing dealer and the selling dealer have acted in connivance to defraud the revenue. This threshold has not been made out in the present case. The department has failed to show that the petitioner as a purchasing dealer deliberately availed of the ITC in respect of the transactions with an entity knowing that such entity was not into existence. So therefore, a much higher onus is sought to be placed on the department by this High Court decision before randomly alleging that there is an allegation of fake invoicing and no goods or services were ever supplied. That takes us to the next basket, which is relating to refunds. And when we talk about refunds, I'm sure all of us bear in mind a recent Supreme Court decision which came in the outskirts on the basis of two contradictory High Court conflicting decisions from the Madras High Court and from the Gujarat High Court. And the facts of this case, as we all are aware, is the provision of Section 54(3), which permits refund of accumulated input tax credit on account of inverted duty structure. And as we all know, this inverted duty structure is a situation where the rate of tax on your raw materials or on your inputs is higher than the rate of tax on your output supplies. In that case, you fit within this inverted duty structure. You will keep on accumulated ITC, and this ITC just becomes a paper asset. Section 54(3) permits a refund of such accumulated ITC. Now, while Section 54(3) permits that refund, Rule 89(5) effectuates that refund by way of the procedures and the rules and the forms to be filed. And Rule 89(5) prescribes a formula. And that formula permits refund only to the extent of accumulation on account of inputs, input services or capital goods. And again, because it uses the word net ITC, which means the ITC during that period minus the output tax, it results in a fundamental bias. And there are some inherent errors which were there in that formula. Now, in this background, the matters were agitated in the writ petitions. The Gujarat High Court gave a benevolent view. It read the word inputs in Section 54(3) to not only include inputs, it interpreted inputs in a generic sense and said that these inputs can be either of goods or services, and therefore inputs would also include input services, and therefore Rule 89(5) is falling deficient. It should not have restricted the refund of input service accumulation. Whereas the Madras High Court went in for a literal interpretation. It observed that there is a definition of inputs available in the law. And if there is a literal definition of inputs which restricts itself to goods, then a purposive interpretation to also include input services would not be permitted. And in this background, because of these conflicting decisions of two high courts, the matters reached the Supreme Court, and the Supreme Court made the following observations. It said that the theory of equivalence will not permit the reading of words not expressly used in the statute. Now, this is very important. It said that yes, there is unjustness caused because of this, but if there is an unjust aspect, it may be because of a policy decision. You cannot use a theory of equivalence to read words which are not there. So therefore, a strict interpretation of the provisions were done. Refund is a concession, it's not a right. And therefore, while giving a concession, there can be a reasonable discrimination, a reasonable classification, and there one cannot bring in a theory of equivalence to read input services within the concept of inputs. It also agreed that the formula has anomalies, but it said that the court will not sit into these anomalies and rectify those anomalies. Also, these anomalies will not result into a situation that the rule itself becomes invalid. You approach the GST Council, and in fact, the order itself says that GST Council should try to rectify these anomalies. Of course, the council did try doing that by amending the GST rates on certain products. And thereafter, again, there was a fallback from those rates. And therefore, to that extent, the matter is open. But somewhere this decision does bring out the aspect that input tax credit refunds, these are concessions, these are not rights. And therefore, in these types of things, the courts will not intervene in trying to treat certain provisions as unconstitutional or trying to give a benefit to an assessee only on the grounds of logic or only on the grounds of equivalence. But they would strictly interpret the provisions of the law as they are stated and literally as they are mentioned in the Act. That takes us to another decision from the Madras High Court in Platinum Holdings. And again, there are a series of decisions around this point, wherein somewhere at a ground level, there has been a myopic interpretation of the provisions. And as we know that whenever an SEZ procures certain goods or services, it can procure goods from DTA against a payment of tax or without payment of tax, because the supplies to SEZ units and developers are treated as zero-rated supplies. And there is a mechanism where the supplier can collect the tax and claim rebate itself. And there is also a possibility that the SEZ unit can file a rebate application. And in this scenario, Platinum Holdings procured goods and services from a DTA on payment of tax. It filed a refund applications since such transactions constituted zero-rated supplies. This refund was rejected at the ground level on the grounds that the supplier is eligible for filing refund application, and SEZ is a recipient of supply and therefore he is not eligible for the refund. And here again, the Madras High Court, in a very detailed and a nice judgment, came to the conclusion that the SEZ unit is entitled for refund as a recipient. Of course, there have been decisions in the past to that extent also, but this was a much more elaborate decision. So I thought this might be relevant for us to bear in mind. A similar view taken by the Gujarat High Court following its original decision in the case of Britannia Industries, wherein the corporate office through an ISD distributes credit to an SEZ unit, and the SEZ unit claims a refund of this credit distributed to it. IPCA Laboratories, Gujarat High Court revalidates the view that the refund can be claimed of that credit distributed to the unit of the SEZ unit of a particular organization from its ISD. Now, this is one area which again shows the type of myopic vision which at times the ground level authorities have. This is a situation where an e-commerce operator collects TCS from the seller. This TCS, as we all know, is available as a credit in the electronic cash ledger of the seller, and he would typically use it for paying his output tax. Now, in many cases where the value addition between the purchase and the sale is very minimal, there will be an accumulation of balance in the electronic cash ledger. This is a cash ledger, make no mistake, not the credit ledger. And naturally, the sellers would then apply for a refund of the balance lying accumulated in the electronic cash ledger. The law clearly permits anytime refund of the balance lying in the electronic cash ledger. But in this case, the refund application was rejected on the grounds that TCS is not paid by the seller, but it is paid by the e-commerce operator. And therefore, he is not eligible to file a refund application. And this is where the High Court went into interpretation of the word paid, because effectively the amount is borne by the taxpayer in this example, which is the supplier. And therefore, once TCS becomes a part of electronic cash ledger, the Telangana High Court held that the refund thereof is clearly permitted in cash. This is one more interesting decision on the procedural side, a very recent decision in C.P. Ravindranath Menon's case, Bombay High Court, where the fact matrix, the High Court did not go into the merits of the case, but just for the background of everyone here, we may understand the fact matrix. It was a case where a petitioner bought flat and entered into an agreement for sale with a developer. The developer collected and paid the GST. The petitioner could not obtain a loan, who was a normal salaried employee. He could not obtain a loan, and therefore the transaction was later cancelled. Due to some disputes, no formal cancellation deed was entered into. The petitioner got a refund of the base amount, but the developer did not want to take any chances. So the GST was not refunded. The GST paid to the government was as it is. The petitioner applied for a refund by filing a manual refund application. And this manual refund application was rejected on the grounds that Circular 125 requires refund applications to be compulsorily filed online. And in this background, the Bombay High Court relied on its earlier decision in Lakshmi Organic Industries case and referred to Rule 97A, which permitted manual refund applications in certain circumstances, and said that Circular 125 cannot override Rule 97A and permitted this manual refund application. Of course, the High Court did not make any comments on the merits of the case, for which necessarily the refund authority would make a position of whether there was a merit in the refund and whether it should be given on merits or not. But on the technical ground that it was filed manually instead of being filed online, the High Court instructed that this should be accepted as a valid refund application filed by the petitioner. This is one more case on procedures. And as we are all aware that refund applications have to be filed within a period of 2 years from the relevant date. And there is a definition of relevant date. We have graduated from the excise service tax regime to understand that there is no possibility of extension of this relevant date, and statutory time limit and no condonation is generally permitted. In the facts of this case, the refund was filed after the period of 2 years on account of pandemic. We are aware of this notification 91, which extended the time limit on account of pandemic only up to 31st December 2020. We are also aware of a Supreme Court decision which took a suo motu cognizance of the pandemic and extended the timelines for limitation in case of judicial and quasi-judicial proceedings up to 20th February 2022. Now, of course, we are aware that there's a circular which says that the Supreme Court decision applies only to judicial and quasi-judicial proceedings, and for the day-to-day activities, including the refunds and the return filing and other processes, this extension, Supreme Court decision does not apply. In this context, the Bombay High Court comes to the rescue of the refund applicant and says that the Supreme Court extension order will apply to refund applications as well. And therefore, if the refund application is filed, if it was eligible for this benefit of this Supreme Court extension, it could claim that extension and file the refund application accordingly. And there are a series of decisions, Andhra Pradesh and Bombay High Court, supporting this type of a position. That takes us to registrations. And someone would believe that why would someone need to go all the way to High Court to litigate on something relating to as mundane as registration? Registration is like when you obtain a registration, the department gets a customer and he should be more than willing to get a customer. But well, we find situations day in and day out where registration applications are rejected and the SSE is left high and dry and he has to approach the courts. And we have a few examples. Of course, there are many more, but I thought we'll cover 2 or 3 interesting examples which we can talk about and wind up on this point of registration and the decisions on that fact. The first decision is an interesting decision wherein there has been a perennial debate of whether GST is a one nation, one tax, and if a registration in one state permits you to raise invoices through IGST to other states and not obtain local registrations. The facts were there was a situation where a government undertaking was issuing a tender notice inviting bids. And the terms and conditions required that the bidder should have a registration in the place where the site is operating. And in this particular scenario, Pragati Engineers, who was a bidder, was registered in Delhi, and the work was to be undertaken in Hyderabad, where he was not registered. And therefore, the petitioner filed an application and appeal against the tenderer and approached the High Court. And what Pragati Engineers tried to say in this litigation was that, look, I am registered in Delhi and I don't have any place of business in Hyderabad, and therefore my Delhi registration should suffice. The tender instruction requiring me to have a registration in Hyderabad is incorrect, and it is an onerous on my part. The Delhi High Court said that one cannot claim that a registration in one state is sufficient. It referred to section 22, which requires registration in each state from when one carries on the business. And to the argument that the petitioner did not have a proper place of business, the Delhi High Court referred to the provisions of casual taxable person and advised Pragati engineers that you can obtain a casual taxable person registration, but there is nothing wrong in the tender condition which has been mentioned here. So this somewhere brings in a little bit of a difficulty in terms of our local registration and somewhere conflicts with the advertised position of GST being a one nation, one tax. The second one is again a case where we will find that there has been a utter non-application of mine. As we are aware, there is a section which permits the officer to cancel a registration on the grounds that the business is not carried out from the registered premises. Now, during the lockdown period, most of the companies had worked from home, and at that point of time, if the officers visited the business premises and they did not find a person operating from those premises, this was a case where the registration was cancelled on that ground that the business was not carried on. And that's where the entity then had to approach the authorities with a revocation application, explaining these detailed grounds. Even that revocation application was rejected, and the matters went to the High Court, and the High Court came back to the rescue of the taxpayer and said that yes, this is a valid ground for not carrying on business from that registered premises due to the lockdown situation. However, the matter was remanded back to the registering authority to consider the submissions and take a balanced view. So this is the type of the situation where an SSE needs to run from pillar to post just for a simplistic thing like continuation of a registration. We have another situation where the registration was cancelled while on physical verification, it was found that the building is partially completed. And as we are aware today, there are many cases where in partially complete buildings, there will be businesses being carried out. And another reason was that the building number was not mentioned on the building. Again, the Kerala High Court said that this could not be the grounds for cancellation of registration, and it directly restored the registration. There are many more decisions on registration, but all of this somewhere suggests the type of the chaotic situation which at times is prevailing at the ground level. That takes me to the penultimate basket of discussion today, which is relating to the returns, and thereafter we'll talk for 5 minutes on the other enforcement actions, and then maybe we can take up a question or two depending on the time. And this is again a celebrated decision. Bharti Airtel, all of us are aware. This was a situation for the first few months where GSTR 2A was not implemented, and Bharti Airtel went ahead and paid the entire output tax in cash without claiming input tax credit. And thereafter, it sought rectification of returns and therefore a consequential refund. Delhi High Court permitted that rectification of the respective returns, and the matters went to the Supreme Court. And Supreme Court went into a detailed analysis and analyzed what is input tax credit. It said the grievance of the Bharti Airtel is that GSTR 2A was not operational. But nowhere the law says, and at least at that point of time, nowhere the law said that the credit is available only on the basis of 2A. The credit was available on the basis of books to be maintained by the SSE, and GSTR 2A at the most is merely a facilitator. And just because GST was not operational, it did not mean that the taxpayer could not have claimed input tax credit. In fact, it could have. It could have self-assessed the credit, and the matching could have happened independently at a later point of time. There was a circular also explaining this aspect in detail. And therefore, it said that there was really no loss of ITC, but merely a postponement because of its conscious decision not to claim input tax credit. And it held that the scheme does not envisage any rectification of returns, nor is it administratively feasible. And necessarily because the settlement of funds and all those happens based on the automatic process of the returns being filed. We at times again we want to say that we want revised returns possible, we want rectified returns possible, but I think there are challenges at the government's end, and this is what the Supreme Court was conscious about, and therefore it said that we cannot intervene into this and rectification is not permissible. As a passing reference, they also overturned the Gujarat High Court decision in AAP and Company and upheld the validity of GSTR 3B as a proper return. So in that sense, something where the dust is now finally settled. Now, going to the next aspect where we see a lot of aggression or difficulties coming from the department's perspective, which is whenever there is an investigation, a DGGI or an anti-evasion coming in, 2 or 3 things invariably happen. One is there is always a threat of provisional attachment. And that is where Radhakrishna Industries Supreme Court comes to to the rescue of the taxpayer, comes with a very detailed analysis of what is important before a provisional attachment is taken. And it brings out that provisional attachment is not a normal course. It is a draconian provision and it should be used as an exception and not as a rule. It should not be a default situation. And then the entire section is analyzed to say that before a provisional attachment is done or undertaken, there has to be a formation of an opinion. And that formation of opinion is of what the opinion should be, that it is necessary to protect the interest of the revenue. And this necessary to protect the interest is much wider than the word convenient to protect. In many cases, it may be convenient to protect, but it may not be necessary. So therefore, there is much more onus on the revenue to establish that opinion. And who will make that opinion? It has to be made by the commissioner. And yes, a delegated authority may act upon that opinion formed by the commissioner. Because the opinion is formed by the commissioner, it is not appealable. And therefore, he said that against a provisional attachment, a writ will be maintainable because there is no effective remedy available. The Supreme Court also went into the concept of what is meant by pendency of proceedings, because the provisional attachment could only happen during the pendency of proceedings. And it therefore said that before any proceedings have been initiated or after the proceedings have been concluded, there cannot be a provisional attachment. In fact, in this situation, the provisional attachment was initiated even before the pendency of the proceedings, initiation of the proceedings, and it continued way after the conclusion of the proceedings. It also analyzed that when we talk about conclusion of proceedings, an issuance of an order in original in writing would imply that the proceedings have concluded. Thereafter, it's the appellate route, and then there is a recourse of a payment of a pre-deposit, and based on that pre-deposit, one can take it forward, and there is no requirement of a provisional attachment at that point of time. Having said all of this, it also said that post facto issuance of a hearing is mandatory and a ratification of the provisional attachment is mandatory. Now, while I'm talking about all of this, we also need to bear in mind that thereafter there has been an amendment in the law which permits the provisional attachment after the pendency of the proceedings as well. And it also, of course, there has been an amendment to include the beneficiaries, which is the next decision which we are going to talk about, the Gujarat High Court decision, which is a very recent decision, which came up in the case of a provisional attachment of the properties of the partner and an LLP. The facts here were that the search proceedings were initiated against an LLP and various properties of LLP and the partner were attached. And the court discussed in detail sections 83 dealing with provisional attachment, 90 which casts a joint and several liability of the partners and the firm, and section 137 which talks about a vicarious liability for offenses by the LLP. And it tried to analyze each of them and said that when you look at section 83, it refers to a taxable person. And it went into saying that a firm is a taxable person, a partner is a distinct entity, and it's not a taxable person under the provisions of the GST law. And sections 90 and 137 don't refer to provisional demands, they only refer to confirmed demands. And therefore, those provisions cannot be used to attach provisionally the property of the partner. And therefore, as a first point, the Gujarat High Court gave a verdict to say that the partner's property cannot be provisionally attached in a case of an investigation against an LLP. As far as firm's property is concerned, the Gujarat High Court also said that the firm's property cannot be attached if it results in disruption of business. And the Gujarat High Court extensively relied on a CBEC circular in this regard and said that the goods, stock, receivables, these are all day-to-day activities, and by provisionally attaching those properties, you are bringing the business to a virtual standstill, and therefore those properties cannot be provisionally attached. While I'm talking about all of this, we need to bear in mind that Section 83 is now amended to include beneficiaries within the scope of the provisional attachment. And therefore, while this decision is a very useful decision, moving forward, if the partner is established as a beneficiary of the intended fraud, perhaps the provisional attachment may still be valid based on the amendment of the law. On provisional attachment, we have a couple of more decisions which say that the bank overdrafts and cash credits accounts represent liability and not an asset, and therefore they cannot be provisionally attached. There's one more interesting decision which talks about a scenario where a provisional attachment is conducted on the basis of an interpretation issue. The petitioner in this case was collecting and paying tax at the rate of 12% because as per his interpretation, the HSN classification merited a 12% rate. And the department officers felt that this classification is not eligible and therefore he should be liable for a general rate of 18%. And based on the proceedings, the bank account was provisionally attached. And here again, the Bombay High Court came to the rescue of the taxpayer and said that mere existence of some proceeding does not entitle the department to invoke the draconian powers of provisional attachment. And in case of interpretation issues, it should not be generally invoked, the provisional attachment provisions. Further, the High Court also observed that the petitioner had offered his land, building and machinery for attachment. But instead of choosing these properties for attachment, which could have safeguarded the long-term interests of the revenue as when the interpretation issue was resolved, the department chose a soft target and preferred a bank attachment, which would result in a disruption of business, and therefore that is clearly not something which is a correct way of looking at the entire thing. So I think these are some of the decisions on provisional provisional attachment of property. Another thing which very commonly happens is Rule 86A, which blocks utilization of input tax credit. And that's where we have a recent Bombay High Court decision in Devi projects, which tries to analyze the interplay of Rule 86A with Section 83 and the interplay between a blockage of utilization of input tax credit vis-a-vis provisional attachment. The plea of the petitioner here was that the embargo of utilization amounts to a provisional attachment of property, and the Bombay High Court frowned upon it, and it said that no, there is no provisional attachment of property. The balance in the electronic credit ledger remains your balance only. It's only an embargo on utilization, and therefore it is not a provisional attachment. It went into the procedure of blockage, and as we all know, most of the times we come to know about the blockage only when we go to the website and we try to file a GSTR 3B and utilize the credit. We find that you are not allowed to utilize the credit. And that's where the Bombay High Court agrees with the thought process that says that Rule 86A is meant in cases of fake invoicing and to safeguard the interests of the revenue. And the very nature of Rule 86A contemplates that there is no prior notice to be issued before blocking the credit. Having said so, since the order is made under Rule 86A, the taxpayer neither has an appellate or a revisionary remedy and therefore permits a filing of a writ petition. So therefore, in these types of situations, no alternate remedy being available, the taxpayer can approach the writ forum with a little bit of a comfort that yes, the writ will not be rejected at the threshold. The High Court brought in a very interesting observation, which is not happening at a ground level, and perhaps it can be of a use. It says that while no prior notice is to be issued before blocking the credit, a post-decisional or a remedial hearing has to be granted within 2 weeks of blocking of credit. And if based on the representation of the taxpayer, it is found that there was no genuine case for blocking of credit, then the blocking should be revoked, or if the commissioner finds that the blocking was correct, then the blocking should be confirmed. So therefore, a post-decisional or a remedial hearing should be granted was what the Bombay High Court observed in this entire situation. Similarly, in another case where the officers blocked a nil balance and said that, look, I now want to freeze this ECR balance, no fresh credits will come in, no debits will go out. In these types of negative blocking, Samay alloys, the Gujarat High Court says that this type of a negative blocking is beyond Rule 86A. It's only if there is a balance, you can say that a part of this balance cannot be utilized. But if there is no balance, you cannot say that in future, no credits will be taken into this and no debits will be made from that. That type of a negative blocking is not permitted, is what the Gujarat High Court held recently. Again, this has the rule itself very clearly says that the blocking cannot continue for more than 1 year. And we have had various decisions where the courts have intervened to say that if it's a block for more than 1 year, then it should be immediately rescued and released. And our latest one decision is of 2022 decision of the Gujarat High Court in Ambika Creations case. There are many more, but I thought I'll just take up one recent one. Okay, now I'll just take a couple of minutes because I think I am a little bit behind my schedule, but just a couple of decisions to take home the point. This is relating to an adjudication. Facts of this case were that the show cause was uploaded on the state portal, and we are aware that in some states, the state portal is different from the common GST portal, and there are backend linkages. So while the officer uploaded the show cause on the state portal, because of technical glitches, it did not find way on the GST portal, and therefore the taxpayer was not aware of the show cause at all. No response was therefore filed. The officer passed an ex parte order, which again may not have come to the attention of the taxpayer. And it was only when a bank was attached and recovery proceedings initiated that the taxpayer came to know that there was a show cause, there was an order, and all of this was never served on him. And that's where when the matter went in the writ court at the Madras High Court, the department said that section 169 permits service of notice by any of the alternative modes listed therein, when one of them is, of course, service on the portal. The High Court said that yes, there are glitches in the portal. Until all the problems are resolved, the High Court instructed that there should be a simultaneous service of notice on the portal as well as a physical notice. So this is again one place where the portal and the system glitches were recognized by the department, by the High Court. This is a case where a lackadaisical approach of the officer in issuing a show cause in a mechanical manner and violating principles of natural justice were all identified by the Jharkhand High Court, and the show cause notice was quashed, and the officer was asked to issue a show cause notice in a detailed manner with all the formats fully filled in and detailed grounds and the facts coming out clearly in the show cause notice. Again, a case where show cause notice was issued, but the order was passed without granting an opportunity of being heard. The Andhra Pradesh High Court held that the principles of natural justice are not satisfied and the demand was set aside. This I think we can skip for the time being. I think this is an important one, and the last one which we would try to take is a decision from the Orisa High Court, where if the order is against you, and this was typically a case where a demand was raised for works contract services, the company filed an appeal before the first appellate authority and paid pre-deposit from electronic credit balance, and the first appellate authority rejected the appeal as defective, since the pre-deposit was paid from electronic credit balance and not from electronic cash ledger balance. And the Orisa matter went to the writ petition in the High Court, Orisa High Court, and the Orisa High Court held that the electronic credit ledger can be used for only paying output tax, and the pre-deposit amount does not constitute an output tax and therefore cannot be paid from an electronic credit register, and it has to be paid in cash only. Now, this of course can open up a Pandora's box and could be a nightmare, especially considering the fact that most of the demands today are relating to input tax credit themselves. And therefore, any rejection of input tax credit, if I already have an input tax credit balance, and that demand, if I'm forced to pay from electronic cash ledger, one will have to really question whether that is correct or not. Also, the law is benevolent to the extent that the CBC issued a circular permitting payment of service tax pre-deposit through a DRC challan in electronic credit balance. There is a tribunal decision in Delhi International talking about it. And when we try to reconcile those aspects with this decision, perhaps again one might believe that the High Court has gone into a very myopic view of the matter rather than taking a more holistic view of this entire approach. I think that was all from my side. I think I've already overshot the time. I'll pass it on back to the President, and thank you very much for a very patient hearing. Thank you.
Thank you, Sunil. As usual, your dissection of the law is so immaculate that all these decisions which you have just discussed will be of great help to the participants. And without wasting much time, I will just request Mandar to propose a well-deserved vote of thanks.
Thank you, Abhay bhai. Thank you, Sunil bhai. Can I take two questions, because I know we are short, because I'll just take two questions, very important one.
Sure.
The first question which is coming up is that now that the GST tribunal is not yet formed, whether everybody has to compulsorily go for the High Court, or is there any other remedy which is clarified by the board?
So in the absence of the tribunal being set up, I think there will be only option available would be a High Court after a first appellate authority order. When we are talking about High Court, please also understand one aspect that if you are ready to pay the 10 and 20% pre-deposit, assuming it's a demand, then till the time the High Court tribunal is set up, you have a virtual stay for the balance 70%. Now, therefore, depending on materiality and the complexity of the issue, you will have to take a position. Yes, where there are refunds stuck up, there is no alternative available to the taxpayer but to litigate to the High Court. But if these are demand matters and if they are one-off demand matters, one may just want to pay 10% and 20% and keep the matter in cold storage till the time the tribunal is really set up.
Okay. The second question is this DY Bittles case, considering the recent amendments which are made by the Finance Act, what would be whether those observations will be relevant even after 1/4/2022?
So what happens after 1/4/20? We don't know which date which becomes effective, but because it's a proposal which is being brought in section 42, it reiterates what was there in section 16(2). So essentially, it doesn't bring out anything additional on the front of the obligation to make the payment of the tax. Though it does say that you have to reverse the tax, and if system itself is going to identify that aspect for you and reverse the tax, I think there's hardly any recourse available to you. I am more worried about section 38. Which basically brings in a lot of onus in terms of the concept of restricted credit and other aspects. So that is something which is more challenging as compared to, I would believe, section 42.
Okay, thank you, Sunil bhai. Before thanking you formally, I have just two announcements to make. So I request participants to bear with me for a couple of minutes. Friends, the first announcement is regarding to the Taxation Committee, which has organized a lecture meeting on direction of tax policies in India. And the address will be delivered none other than Honorable CBDT Chairman Shri J.B. Mahopatra. The lecture meeting is scheduled on Wednesday, 9th March, between 5 p.m. to 6 p.m. So this is the first announcement. I request all of you to take a benefit of it. Friends, the second announcement is regarding our flagship event, which is an event organized by Indirect Tax Committee. It's a 16 residential study course exclusively dealing with various aspects, academic aspects of the GST. This time we have selected a venue, Goa. So the RRC will be held in Westin, Goa, Westin Resorts, Goa. The RRC dates are 2nd June to 5th June. But I request all of you to enroll as early as possible, because by 5th of March, we have got a deep discount bonds. We have got a deep discount schemes. And obviously, if you enroll late, the prices will go up. Also, it will help you to book the flights at an early stage. In the RRC, we have got around 2 group discussion papers, 2 paper presentations, and 1 panel discussions. And there is officially around more than 16 hours of learning in these 3 days. And unofficially, I can assure you that there are lots of other hours that will come to your benefit. So with this, I now come to the pleasant task of formally thanking Sunil bhai for this wonderful disposition. Friends, you will agree with me that Sunil bhai has selected very prominent cases, very practical, and which are very useful for us in the day-to-day life. Somewhere he has also tried to bring up a concept that when the accountability is not fixed on the government authorities, probably it is for the courts. Now they are trying to come up to the rescue by imposing certain personal penalties on the department. Some case laws that he discussed are really going to be beneficial for us in our routine ASMT 10 replies and various other aspects. And not to mention that he has very categorically, before going to the judgment, has also explained in detailed manner the provisions under the law, how the show cause notices are being issued, and what is the first step for that. So having regard to all these things, I would suggest that we all have learned a lot today from Sunil bhai. And Sunil bhai, thank you very much for selecting these 20-25 maybe more judgments that you have come up with today. Thank you, Sunil bhai.
Thank you.
Yes, Abhay bhai, I think we can